Aerospace and defense ETF soaring? For a bold trade in this sector, trade DFEN, Direxion's Daily Aerospace and Defense Bull 3X shares. Don't miss your next big trade. Direxion Leveraged ETFs.
An investor should carefully consider a fund's investment objective, risks, charges, and expenses before investing. A fund's prospectus and summary prospectus contain this and other information about Direxion shares. To obtain a fund's prospectus and summary prospectus, call 866-476-7523 or visit us at www.direxioninvestments.com. A fund's prospectus and summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors, such as traders and active investors. Distributor, Foresight Fund Services, LLC.
You're listening to the Index Investing Show. This is America's only weekly program focused on the important stock and bond indexes and the financial products that track them. And now presenting your host, Ron DeLegge.
What are the psychological attributes of successful investors? I want to talk about that on today's program. Also coming up, we're going to give you a rundown of what's going on with key market indexes and industry sector ETFs. We've got a lot to get into. Also, the Twitter feed, I'll get you caught up on that. If you'd like to join us to talk about a particular stock, mutual fund, ETF, or investment strategy, 844-305-7800 is the number. Give us your first name along with your city. You can also tweet the program at Index Show. That's where you find us on Twitter. And we'll get you again caught up what's going on the Twitter feed. Got some really, really good links. So taking a look at November, here we are. And the performance so far has been choppy for stocks. We saw the S&P 500 fall about 1.5% this past week as key industry sectors like consumer discretionary, technology, and energy all sliding. And in the news, a couple of companies within these groups, of course, Apple, a big component of the technology sector ETF, ticker symbol XLK, said it would no longer report unit sales for its iPhones, iPads, and Macs. And I guess the market interpreted that to be negative. Apple shares declined by 5%. And also they said that they cut their annual guidance. Well, actually, this is a supplier of Apple. One of their facial recognition suppliers said that it cut its annual guidance after smaller shipment requests from a large customer. Of course, that large customer being Apple. So that was interpreted to be negative, that sales of mobile devices for Apple will be much, much weaker in the future. So that was news in the technology sector. NVIDIA Corporation, another big company within the tech sector, chip maker, missed earnings, expectations on earnings, and projected declining revenue for the current quarter due to excess inventory from the cryptocurrency boom. So that boom with the cryptocurrency, by the way, has been big time here in 2018. Cryptocurrencies are in a bear market. They have been pretty much for all of 2018. But NVIDIA took it on the chin, falling by 20% this past week. And, of course, that weighed on the technology sector. So that's kind of what's going on with some specific companies. We'll get you caught up on a couple of other companies in the news, Macy's, Facebook, as well as Boeing. So stay tuned for that. 844-305-7800 is the number. We're here. This is the Index Investing Show, and this is where we congregate each week to talk about the birds and the bees of successful investing. Of course, as I teach you on this program, it's all about having a three-leg stool in terms of your investment portfolio's construction. So you've got the core or the foundation built upon low-cost index ETFs that are broadly diversified that touch the major asset classes like stocks, bonds, real estate, and commodities. That's the core. And then you complement the core with your non-core portfolio, which can own assets that are more strategic in nature. Assets like sector ETFs, assets like individual stocks. You can also engage in high income strategies, investing in areas that may pay a higher yield or dividend in order to generate more income. You can engage in strategies like selling covered calls, for example, which is an excellent strategy for generating more cash flow beyond what you get from dividends. So that's your non-core portfolio. You can also, by the way, short and use leverage in your non-core portfolio. Again, that complements the core. That's your second stool. And then your third stool or third leg of the stool is your margin of safety, which refers to the portion of your portfolio that is strictly geared for capital preservation. It's all about safety. It's all about zero volatility. And those of you that say, well, this is going to put a drag on your portfolio's performance over long periods of time, why would anyone have a margin of safety? Because if you're looking at a span of 5 years or longer, that capital preservation, that cost of safety is going to exceed its benefit. And to that I say hogwash. Everybody needs a margin of safety. Now, the question should really be, how large should your margin of safety bucket be? That's the real question. And the answer that I'm going to give you is that it depends a lot on you. Everybody has a different level of risk tolerance or risk capacity. And so somebody, for example, that has a higher level of risk tolerance can have a lower portion of their portfolio committed to margin of safety. Conversely, someone that has a lower tolerance for risk would have a higher portion of their portfolio committed to the margin of safety bucket. Now, the other thing beyond the psychology of what your level of risk tolerance is deals with your age, because age is very important. Simply put, those of us that are at or already in retirement need a larger margin of safety compared to somebody who's just getting started saving and investing for retirement, or even somebody who's, let's say, mid-career and maybe has another, let's say, 15 to 25 years to go before retiring. So those of you that are retired, need to have a larger portion of your assets committed to margin of safety because of the fact that you don't have what they have, and that is time. You don't have a long time span to recover from a major market event, whether that's a bear market, a market crash, a market correction that's severe. You don't have a long time like you did before to recover from a major event. And also, too, you're also tapping your assets. You're withdrawing money from your retirement portfolio, which makes that the risk of running out of money that much more acute. And so this is why you have to have, especially as you near retirement or head into retirement or are retired, you got to have a adequate margin of safety for your situation. So this is the framework for having an architecturally sound investment portfolio. And it's something that I teach on this show. It's something that I also teach in my online classes, which if you haven't yet joined, I encourage you to do that. You can go to my site, indexshow.com, and click on some of the online classes, and you can find the classes there. There's 3 of them. One is geared for those of you that have had a portfolio report card, where I've analyzed your portfolio, you've been graded, you've seen the results, and now you want to try to make some improvements with your portfolio. So I have a class just specifically geared for those folks. I've got another class, which is really my flagship class, called Build, Grow, and Protect Your Money, a step-by-step guide. which will teach you all of the things that I'm telling you right now. Plus, you get an investment policy statement that you can fill in the blanks, and you get 27 model ETF portfolios, plus a margin of safety worksheet. That's what you get along with all of the video modules. And then the last course is really geared for those that got a late start for saving for retirement, called a rescue plan for retirement late savers. So this is the Index Investing Show. If you're just joining us, we got a lot to talk about on today's show. We're going to get you caught up on the Twitter feed, and we're going to talk about the psychology of successful investors. What do they do that the rest of the world doesn't do? That and much more. I'll be right back.
The Index Investing Show with Ron DeLegge.
You're listening to the Index Investing Show with Ron DeLegge. Go to indexshow.com to enroll in Ron's online classes for investors. Learn how to grow and protect your money.
All right, 844-305-7800 is the number. This is the Index Investing Show, and we're here if you want to talk about anything on your mind, a particular stock, mutual fund, ETF, or investment strategy. We've seen a rise in market volatility really since October. Stock market volatility is shot higher, and actually, that's presented some great opportunities. We've talked about it on last week's program with Sylvia Jablonski at Direction Investments, that higher volatility is often portrayed as something negative in the media. Well, we want you to know that it's not something negative. It's something quite normal in financial markets. It's also something that we see in nature, because markets do, in fact, mimic, to some extent, what we see in nature. Nature has volatility. If you look at the ocean, it's not flat. The ocean has waves. The ocean moves up and down. And sometimes when there's a storm, it moves up and down a lot. And so financial markets, in many respects, are merely a reflection of what's happening in nature. They're also a reflection of human emotion. It was the great Gerald Loeb that once said that it's an excellent, or it's wise to remember that too much success in the stock market is in itself an excellent warning. So what he was saying is that market prices are shaped by human psychology, and it's really the world's greatest investors, the legends, that stand out for their psychology. What do they do that others don't do? And so I want to talk about that on today's program, because there are many things that successful investors, legendary investors, do that the rest of the world doesn't do. Now, one of the things they do very well, as the great John Maynard Keynes said, he said, successful investing is anticipating the anticipations of others. So what does that mean? Well, successful investors are able to somehow precisely anticipate how others are going to react. Not an easy thing to do. What that indicates is that the successful investor is an observer, a keen observer, looking at market conditions, looking at market prices, and trying to discern really what is the market psychology, what is the mood, anticipating the anticipation of others. That's something that the great investors do. So that's one of the things that we want you to have, is to be an observer. Look around and see what's going on. Don't just listen to me or anyone else or the media or what you digest on a blog. Be observant. See what's going on in your own neighborhood. See what's going on in financial markets. What are market prices telling you? Because remember, there's a million different indicators out there, but I like to focus on the price action of the major indexes, because that is a leading indicator. Stock prices are a leading indicator. That can tell you what exactly is going to go on and what's going to happen and what is likely to come about in the future in terms of the economy, in terms of a lot of things. So be observant. Look around and see what's happening and what's going on. See what the trend is. Keep abreast of that. 844-305-7800. That's the number. We're here. You're listening to the Index Investing Show. I want to talk about a couple of other companies. Boeing Boeing was down a little over 2% this past week, and they've had some issues with the 737 model. There was an accident last month with a company called Lion Airjet. And so there's been some questions about the 737 models and the safety issues and so forth. So Boeing was down a little over 2%. Of course, that's part of the industrials. Ticker symbol XLI is the ETF that tracks industrials. And industrials have struggled here lately. They are, on a year-to-date basis, down about 3.5%. So some of that is also due to the ongoing multinational trade war between U.S. and China. And that's certainly weighing, I think, a lot on industrials besides Boeing's issue. Some of these multinational industrial companies like Caterpillar and John Deere and Company and the like. And so that's been a pressing issue for industrials. It's also been an issue for energy stocks. XLE is another area that's been very weak, down about 5% on the year. Again, these are modest losses. We're not in a bear market by any measure. We are in a correction. But no matter how the White House spins it, trade wars, multinational trade wars, are not bullish. And the trade war time bomb is set to explode on January 1st, 2019. And very sadly, there's a radical minority out there that are eagerly delighted to see it happen. They just can't wait for the trade war time bomb to explode so that they can prove a point. They've got a point that they want to prove. I mean, who needs diplomacy when you can just spew propaganda peppered with economic death threats? It's become today's devolutionary narrative. And this yearning for last-minute deal between China and the U.S., I mean, isn't that what we're all hoping for? We're hoping that that happens before the end of the year. It's probably unfounded at this point. It doesn't look very promising. But if we say that, well, it's going to happen, the question then becomes, well, has the damage been done? Because if you take a look at the leading indicators, they're indicating, there's been a lot of damage already done by this trade war nonsense. I mean, you've got key S&P 500 industry sectors like industrials, like energy, like materials, all down about 3 to 7%. These are modest losses. But the question is how much damage has been done. Just wait until fourth quarter corporate earnings come out in the first quarter of 2019. I don't think it's going to be pretty. And the question is that built in to market prices? Has the market priced in this lack of business, this lack of free flow of trade that's been hindering these markets? So we've got that we're watching. Also, in December, let's not forget the Federal Reserve is going to hike interest rates. They're expected to do that again, and that's been weighing on the home building sector. We talked about this particular area in the just released issue of ETF Guide Premium, and yes, we're short in ETF Guide Premium. We're short the Spiders S&P Home Builders ETF as ticker symbol XHB. We're using put options because there are no inverse performing or short ETFs linked to home builders. So the play is the put options increase in value when home building stocks go down. And so to find out the strike and the expiration on those put options and the exact play, you can go to etfguy.com and become a premium member. But home builders are beaten up, and really, I guess I see more downside ahead for this group. And I don't see how this group is going to have a very good future in the immediate future. So that's another trend I am closely watching. This is the Index Investing Show. I'll be right back after this short break.
The Index Investing Show with Ron DeLegge.
Are emerging markets on the move? For bold trades on emerging market stocks in either direction, trade EDC or EDZ. Directions Daily MSCI Emerging Markets Bull and Bear 3X shares. Don't miss your next big trade. Direction leveraged ETFs.
An investor should carefully consider a fund's investment objective, risks, charges, and expenses before investing. A fund's prospectus and summary prospectus contain this and other information about Direction shares. To obtain a fund's prospectus and summary prospectus, call 866-476-7523 or visit us at www.directioninvestments.com. A fund's prospectus and summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors, such as traders and active investors. Distributor, Foreside Fund Services, LLC.
Have an investing question for Ron? Call 844-305-7800 or send your questions to @IndexShow on Twitter.
Okay, there's one area that I want to tell you about here that has been a pretty good performing area, and that's healthcare. Healthcare so far in 2018, you might say this is one of those industry sectors that's relatively defensive in nature, just because of the fact that, listen, we've got an aging population. More and more people are going to need medical and healthcare services, and also pharmaceutical products, and that I think has helped the healthcare stocks and group within the S&P 500 to hold up much better relative to some other sectors. XLV, V like Victor, which tracks this area, is gained 12.5% since the beginning of the year. So this has been a very, very good performing industry sector. Also, the leveraged ETF from Direction that aims for triple daily performance to healthcare stocks has been a great performer. Cure, that's a pretty easy name to remember. Cure is the ticker symbol, CURE, and that ETF is ahead by just over 26%. Some of the top holdings within XLV, remember XLV tracks just the healthcare companies or stocks within the S&P 500. So there's 63 of them, 63 healthcare stocks within XLV. You've got top holdings include Johnson & Johnson, United Health Group. You've got Pfizer, Merck, AbbVie, Medtronic, Abbott Laboratories, Amgen, Eli Lilly. And you've also got Thermo Fisher Scientific, Gilead Sciences. These are just some of the top holdings within XLV. So a great way to play that particular trend of healthcare and the aging population, and just a really all-around solid industry sector performer. 844-305-7800 is the number. We're here. This is the Index Investing Show. If you'd like to join us to talk about anything on your mind, if you'd like to get a free analysis of your investments, your retirement portfolio, you want to know exactly what's going on with your money and how you're doing, go to portfolioreportcard.com and get in touch with me. I will give you a one-page analysis of what's going on with your investments in a couple of key areas, including cost, risk, as well as taxes. So check that out at portfolioreportcard.com. On my Twitter feed, at Index Show. These are some of the stories I'm following and tweeting about. Here's a link to a story about how Trump tax cuts are already being eroded by a switch of inflation. The IRS announced details of a change in calculations required by tax law, meaning tax brackets and deductions now grow more slowly. So that's impacting a lot of retirees, and we're going to start to see that happen more. Right now, it's just beginning. So you can digest that particular article that was from the Wall Street Journal. Also, a link to an article about Social Security, and a very surprising and uncomfortable fact that Social Security recipients must return. They must return Social Security payments received in the month they die. So you can't take it with you. If you receive a Social Security monthly payment and you pass away in that same month, you have to return it. Also, on the Twitter feed, some general comments about robo-advisors, a movement which I have disdain for. I said this: after years of undermining human financial advisors, robo-advisors are now trying to recruit them. Ha 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 ha! Belatedly, of course. Robo-advisors, I guess, now recognize what a deeply flawed business model they have. It's so deeply flawed that they badly need human advisors, and they're now trying to recruit them. Let me just say this: the depersonalization of financial advice has and always will be a devolutionary trend. And that's what I think robo-advisors represent. It's a devolutionary trend of depersonalization in financial advice, or you could even say faux or fake personalization, because they make it look like and they make it seem like it's customized advice, but it's really not. It's just a faceless algorithm that's spitting out portfolio results, portfolio allocations. This is the same tack that target date mutual funds have been doing for over 2 decades. And again, it's a devolutionary trend. It's not something I support at all. How about, is there any art fans out there? Edward Hopper, one of the all-time greats, had a painting called Chop Suey. Chop Suey, like Chinese food, Chop Suey, sold at auction for a record and a staggering number, $91,875,000. Can you believe that? Chop Suey. I mean, it's not one of the absolute greatest Edward Hopper paintings ever, but this is a classic example of supply and demand economics. The supply of top caliber Edward Hopper paintings is so low and so non-existent that demand is pushing up prices into the stratosphere. And that's why you'll see a painting like Chop Suey from Edward Hopper sell for almost $92 million at auction. I mean, if that's worth $92 million, what the heck is Nighthawks worth? Or Early Morning, which I think is at the Whitney Museum in New York City. Another legendary painting, in my view, far greater than Chop Suey. But, I mean, this is amazing. If this painting, and I'm not saying it's a second-tier painting, but it's certainly not at the same caliber of an Edward Hopper, Nighthawks, or the one at the Whitney Museum, Early Morning. So anyway, that's what's going on my Twitter feed at Index Show is where you follow me, and you can read about that and much more. 844-305-7800 is the number. We're here talking about the psychology of what separates great investors from the rest. Here it was that Warren Buffett, he had this to say, and I think this lends itself to our discussion of having an adequate margin of safety. He said, one single big mistake could wipe out a long string of investment success. Isn't that true? one single big mistake could wipe out a long string of investment success. And so it's very important to not get overconfident about any success that you've had. And it's also important to understand that you sometimes have to take gains. You have to realize gains. Sometimes the composition, sometimes the character of companies and their situation changes. You know, if you held a company, for example, like Sears, a company that was legendary, that looked like it could do no wrong in the 60s and 70s, and you held that as a long-term investment through today, all of those gains have been lost. So you had success in the 60s and 70s and possibly 80s, but all of that success was wiped out because the company was mismanaged. The company was not able to adapt. And so that's, I think, one of the things that separates legendary investors from the rest is they're able to understand that. Also, they're able to think like contrarians. And I want to discuss this a little bit more in the next segment because I want to give you a real-life example of what we did at ETF Guide Premium and why thinking like a contrarian is something that's a hallmark of the true greats. I'm Ron DeLegge. This is the Index Investing Show. I'll be right back.
The Index Investing Show with Ron DeLegge.
Stop investing blindly. Listen to the Index Investing Show with Ron DeLegge every week on iTunes and IndexShow.com. Learn how to grow and protect your money.
We just got an off-the-air call from Randall in San Francisco pointing out David Hockney, another great artist who is from England, just had a painting sell at auction for, I think, $90 million, which is actually a record for a living artist. The painting is called Portrait of an Artist. It's one of Hockney's famous swimming pool paintings that he did in the early 70s. And just an amazing, staggering figure. $90 million for a David Hockney painting. That same painting 46 years ago sold for $18,000. Wow. You want to talk about a return on your capital, return on your income and investment. Man, that's incredible. $18,000 to $90 million. Pretty staggering. We told you earlier about Edward Hopper, one of the greatest American artists, painters, and how that his painting, Chop Suey, sold for just over $91 million at auction. Of course, he's been dead since the 60s, but the question I have, if Chop Suey, and that's the painting that sold for $91 million, if it's worth $91 million at auction, what is Nighthawks worth? What is Early Sunday Morning worth? I mean, that's, of course, those latter two paintings will never go to auction because they're in museums. But look at them, Google them, because they're iconic. Early Sunday Morning, Edward Hopper, one of my all-time favorite paintings. And, of course, Nighthawks, which has been adapted and contorted by various artists and illustrators and tweaked with their own little, tweak on things. But take a look at those two paintings. If Chop Suey is worth $91 million, those paintings easily would, if they ever sold at auction, would easily exceed $200 million. 844-305-7800 is the number. This is the Index Investing Show. We talk about your finances. We talk about art. We talk about money. We talk about retirement income. There's all of these things that pertain to your financial well-being. That's what it's all about. Now, we wanted to mention that if you ever miss our regular weekly radio broadcast, you can pick up all of our shows via podcast. We archive at indexshow.com. Also, iTunes. You can find us there, as well as Google Play, and even on YouTube. So look for us Just search under the Index Investing Show. So, what are the hallmarks of the truly great investors? We've already talked about some of them. Being observant, looking around, seeing what others don't see, being discerning. The other things that successful investors do, they're alert. They're aware. Whereas the rest of the crowd is distracted or unaware. The successful investor is always anticipating change, whereas the rest of the crowd is always responding after the change, or perhaps not even responding at all. The successful investor is constantly improving. The unsuccessful investor is constantly blaming. The successful investor interprets information. The unsuccessful investor misinterprets information or doesn't understand information. The successful investor controls emotion. The unsuccessful investor is emotional. The successful investor is not intimidated. The unsuccessful investor is vulnerable and easily intimidated. You know something else what the successful investors do? When they have a problem, they confront that problem. They deal with it. Unsuccessful investors regret problems, or they're frightened by problems, or they can't deal with problems. And when successful investors are given a bad situation or dealt a bad hand, they somehow, some way, find a way to make it better. Whereas the unsuccessful investor takes a bad situation and makes it worse, or they can't deal with situations. See, these are some of the hallmarks, some of the differences between the truly great and legendary investors versus everyone else. The other thing, and this is mentioned in the just released December issue of ETF Guide Premium, and I'm going to share it with you right now, that legendary investors have, the greats. It was billionaire trader Paul Tudor Jones who once famously said, "To do the trade that makes you puke." Isn't that a great quote? That's one of my favorite quotes probably of all time in investing. Do the trade that makes you puke. And basically we decided to try that. We took Paul Tudor Jones's advice. We did the trade that makes us puke. And in ETF Guide Premium entered the ProShares Short-Term Futures VIX ETF, ticker symbol VIXY, on the final day of May at a price of $30.39. Needless to say that trade in VIXY, from the moment that it was entered back in May, it made us puke. Made us puke. And the SIBO Volatility Index, if you look at the chart from May to really the end of September, did nothing but go down, which dragged down VIXY. And then suddenly, October arrived. And what happened? The VIX popped, allowing us a window to exit that trade, the trade that made us puke, VIXY, with a handsome 12.2% time-stamped gain. Now, that was no accident, that gain, nor was it due to some mystical intelligentsia, right? Some mystical intelligentsia that Wall Street wants you to believe exists. It doesn't exist. It was due to stamina, patience, and stomach. And that's what legendary investors have. They've got stamina, patience, and stomach. Or as I like to call it, SSP. SSP. And buried within that trade is an important lesson. ETF trades, stock trades that start out bad, whatever type of trade that you make, if it starts out bad, it doesn't always need to end badly. Moreover, buying an asset of whatever kind at the wrong price and at the wrong time can indeed be overcome by stamina, patience, and stomach, also known as SSP. So let that be a lesson to you. It's not some mystical intelligentsia. It's not some mystical insight. It's all psychological, folks. And don't let your mind play tricks on you. We are psychological. We are emotional. We are humans. And we need to react in a way that, we got to sometimes step away from it and absorb it and breathe. And what I'm trying to help you understand here is that to have the psychology of a winner. And when it comes to investing, you need to cultivate this if you're going to reach your financial goals, if you're going to succeed. And so I love that quote from the great Paul Tudor Jones. He's a trader. I don't know if he's much of an investor. I think he's more of a trader than an investor. He's always constantly making large concentrated bets. And a lot of the stuff that he does is speculative in nature. But it really gets to the sense of when you say do the trade that makes you puke, is to be a contrarian. Think opposite of the crowd. In fact, one of the greatest contrarians of all time, Warren Buffett, that's what value investing is all about. It's buying assets that other people have overlooked or others dislike or hate or don't appreciate, and waiting for the market to eventually recognize that, wow, these assets are worth a lot more than what people thought. And so that's also a very important thing, is to think like a contrarian. Do the opposite of the crowd. Easier said than done. All of these things I'm telling you are easier said than done. And so these are the things that I'm hoping that you will cultivate and incorporate in your own investment plan. 844-305-7800 is the number. @Index Show is my Twitter handle. That's where you follow me on Twitter. And that just about does it for another episode of the Index Investing Show. Be sure to join us again next week. Same time, same station. We'll be here. And until we meet again, may the market indexes be with you.
The opinions expressed in this broadcast are not necessarily that of our advertisers, sponsors, or broadcast partners. The discussion of investing is general and should not be construed as investment advice or an offer to buy or sell securities. Listeners are responsible for their own investment decisions and results. Before investing in mutual funds or ETFs, always consult a prospectus for risk, charges, expenses, and other information. Read the prospectus carefully before investing. Past performance is not indicative of future results. No reproduction or dissemination of the Index Investing Show is permitted without the expressed written consent of its producers.